Most beginners think the biggest investing mistake is picking the wrong thing. It usually isn't. The most expensive mistake is checking prices every day and then reacting emotionally to what you see. Because the moment your brain turns investing into a daily scoreboard, you stop following a plan. You start following feelings. In this video, I'll show you why daily checking quietly pulls people off track, even if they started with good intentions. And more importantly, I'll show you a calm, simple way to set things up so you don't have to fight yourself every week. Quick framing before we start. This isn't financial advice. It's a clear, educational breakdown of how investing works in real life, especially for beginners, and how a very normal habit can sabotage progress. Nothing here is about quick wins, predictions, or calling the market. This is about building a steady system that you can live with for years without stress. And if you've been checking prices daily already, that's not a personal failure. It's what most people naturally do when they care about something. We're just going to put that habit back into a healthier place, so your plan stays in control. Here's exactly how we'll break this down. Part 1. What this mistake really is and why it feels so reasonable in the moment. I'll explain what daily checking does to your decision-making in plain English. Part 2. I'll prove why it matters with a simple, realistic scenario comparison. Not a success story, not a cherry-picked example, just a timeline that shows how two normal people can start the same but end up with completely different outcomes because of one habit. And Part 3. I'll show you a beginner-safe setup you can use immediately. It's tool-agnostic, it's simple, and it's designed to remove the need to manage your investments every day. In a moment, I'll explain the psychological trap that makes daily checking feel responsible, even when it's doing the opposite. But first, we need to define the mistake clearly, because most people don't even realize they're doing it. Let's name the mistake properly. The mistake is not checking prices. The mistake is checking prices so often that the short-term noise becomes the thing you respond to. Daily checking turns investing into a constant emotional feedback loop. You open an app or a chart, you see green or red. Your brain instantly asks, is this good or bad? Then it asks, should I do something? Then you feel the pressure to justify action because doing nothing can feel like ignoring a problem. And that's where people drift. Not because they're lazy, not because they're unintelligent, because humans are wired to respond to immediate information. If you touch a hot stove, you react instantly. If you hear a loud sound, your body reacts instantly. If you see a number drop, your mind reacts instantly. Daily price checking puts your nervous system in the driver's seat, but investing is one of the few areas in life where the best decisions are often the ones you don't make. That can sound strange at first, so let me make it simple. When you invest for the long term, you're not trying to win today. You're trying to build ownership in productive things over time. And the value of those things will move around day to day, even when nothing truly changed in the long-term picture. Daily movement is normal, but daily checking makes normal movement feel like an emergency. Here's the trap. When you check every day, you're asking your brain to do a job it isn't designed to do. You're asking it to look at random short-term movement and produce calm, long-term decisions. Most people can't do that consistently. Not because they're weak, because the brain treats short-term losses as more urgent than long-term gains. Even if you logically understand this is normal, your emotions don't fully believe it in the moment. So daily checking does 3 things. First, it increases your sensitivity to noise. Noise is just information that feels meaningful but isn't useful. A small drop today might be meaningless. A small rise today might be meaningless. But if you watch it every day, it starts to feel like a story. Your mind starts narrating. It's falling, it's crashing, it's recovering, it's running away without me, it's going to zero. It's going to the moon. Even if you never say those words out loud, that's the emotional energy daily checking creates. Second, daily checking increases action pressure. This is the feeling that you must do something to be responsible. You see a drop and feel the urge to protect yourself. You see a rise and feel the urge to chase it. You see uncertainty and feel the urge to wait for clarity. But investing doesn't reward constant protection, chasing, and waiting. It rewards consistent contribution, patience, and behavior. that stays stable through normal ups and downs. Third, daily checking breaks your ability to stick to a plan. Because a plan is built for the long term. A plan is meant to survive multiple moods. But daily checking turns your plan into something you renegotiate every 24 hours. And eventually, you don't have a plan. You have a series of reactions. Let's make this more concrete. Imagine someone who decides they want to start investing. They're not chasing anything. They're not trying to get rich fast. They just want to be smarter with money. So they pick a simple approach and they start contributing regularly. If they check once a month or once a quarter, they'll notice progress slowly. It won't feel dramatic, but it will feel stable. If they check every day, the experience is completely different. Day 1, it's up a little, they feel good. Day 2, it's down a little, they feel uneasy. Day 3, it's down more, they feel worried. Day 4, it's up again, they feel relieved. Day 5, it's down again. They feel frustrated. Day 6, it's up. They feel like they should have bought more. Day 7, it's down. They feel like they should have sold. This is not investing anymore. This is emotional turbulence. And the problem is not the feelings. The problem is what the feelings lead to. When people react emotionally, they tend to do one of three things. They stop contributing, they sell after a drop, or they jump into something else that feels safer or more exciting. All three are versions of the same mistake, letting short-term movement rewrite a long-term plan. In a moment, I'll show you a realistic scenario that makes this painfully obvious. But before that, there's one more reason daily checking is so dangerous. It feels productive. It feels like you're staying on top of things. And in most areas of life, that's true. If you're tracking your expenses, checking regularly helps. If you're tracking your workouts, checking regularly helps. If you're studying, checking your progress helps. So your brain assumes the same logic applies to investing. More monitoring equals more control. But investing is different. Because the thing you're monitoring is not a stable metric, it's a price that changes constantly. And price movement is not the same as something going wrong. A price is a snapshot of what buyers and sellers are doing in that moment. It reflects emotion, news, uncertainty, and expectations. It moves for reasons that have nothing to do with your long-term goal. So, daily checking doesn't give you more control. It gives you more emotional triggers. And over time, those triggers create decision fatigue. Decision fatigue is when you get tired of making choices. And when people get tired, they start choosing comfort. Comfort looks like selling to stop the anxiety. Comfort looks like pausing contributions to wait until things calm down. Comfort looks like doing something dramatic so you feel in control again. But comfort decisions are rarely good investing decisions. That's why this mistake is so common. It's not a knowledge problem. It's a behavior problem caused by a habit. Now let's prove it calmly with a simple comparison. Let's do a realistic scenario. Two people, same age, same income, same goal, same starting point. They both decide to start investing in a simple long-term way. They both plan to contribute regularly. They both understand intellectually that the market moves up and down. The only difference is this. Person A checks prices every day. Person B checks on a calm schedule, once a month or once a quarter. Not because they don't care, because they do care and they want their behavior to match their goal. Now imagine the next 2 years include a very normal pattern. Not a perfect straight line, not a constant rise, just the usual. Some good months, some bad months, some confusing stretches. At some point there's a sharp drop. Nothing unusual about that in markets. It happens. Person B sees it eventually, during their normal check-in, but when they see it, it's one data point inside a longer timeline. They look at the total picture. They remind themselves, I'm contributing regularly, this is part of it. And they keep going. Person A sees it immediately. Because they check every day, they see the drop in real time. And it doesn't look like a normal part of a long-term journey. It looks like a threat. So what happens next is predictable. Day 1 of the drop, Person A feels uneasy. Day 2, they feel worse. Day 3, they start thinking, what if this keeps going? Day 4, they search for explanations. Day 5, they find 10 different opinions. Some say it's the beginning of something terrible. Some say it's a buying opportunity. Some say nobody knows. Now Person A is overloaded. They don't feel informed, they feel confused. And in confusion, most beginners make a decision that feels like risk management. They pause contributions, or they sell a portion, or they sell everything with the plan to buy back later when it's safer. That last one is extremely common. It sounds logical. I'll step aside until it stabilizes. But here's the catch. Markets often feel the scariest near the bottom, and the recovery often begins before people feel comfortable again. So person A sells or pauses and waits for a clear sign that things are better. But clarity usually arrives after prices have already moved. So the price goes down, person A exits or pauses. Then the price stabilizes. Then it starts rising. Person A watches it rise daily because they're still checking daily. Now a new emotion arrives. Regret. I should have stayed in. I should have kept contributing. I missed it. So what do? They jump back in, but notice the pattern. They reduce exposure after a drop. They increase exposure after a rise. That's the opposite of what you want. I'm not saying this to judge anyone. This is normal human behavior. But it's exactly why daily checking is a mistake. It pulls you into a rhythm of reacting to feelings. And feelings tend to be strongest at the worst times. Now let's compare outcomes without using promises or fancy numbers. Person B simply keeps contributing. They buy through the drop. They buy through the uncertainty. They buy through the recovery. Their experience is emotionally boring, and that's good. Person A contributes inconsistently. Maybe they stop for a few months. Maybe they sell and later buy back. Maybe they change the plan midway. Even if person A makes reasonable choices, the big impact comes from one thing. They didn't stay consistent. And in investing, consistency is not a small detail. Consistency is the engine. Because the goal isn't to be correct today. The goal is to own more over time, steadily, through different conditions. Here's another way to see it. Think about a gym routine. Person B trains on a schedule. They don't change their workout because they feel tired one day. They don't quit because progress looks slow after 2 weeks. They keep showing up. Person A checks the scale multiple times per day, morning, afternoon, evening. Every time it changes slightly, they change the plan. They eat less, then they eat more, then they switch workouts, then they stop. They're not lacking effort, they're just reacting to noise. Daily weight changes are noise. Daily price changes are noise. The problem is not looking. The problem is treating noise like a signal. Now there's one more proof point that's simple and powerful. Investing results are not built by one perfect decision. They're built by avoiding a few destructive decisions. The destructive decisions are usually made during emotional extremes. Panic, euphoria, frustration, regret. Daily checking increases the frequency of emotional triggers, so it increases the chances you make a destructive decision. Even if you only mess up a few times over years, that adds up. Because the biggest advantage a beginner can have is time. And the biggest way you lose time is by stepping out, pausing, or constantly changing course. Before I show you the exact setup to avoid this, I want to make one thing very clear. The goal is not to become emotionless. The goal is to build a system where emotions don't get a vote. You can feel nervous and still follow your plan. You can feel uncertain and still follow your plan. You can feel tempted and still follow your plan. A good setup makes that easier. In a moment, I'll give you a simple, beginner-safe structure that reduces daily checking naturally without relying on willpower. But first, let's understand why willpower fails here. When the market is calm, everyone feels disciplined. When the market moves sharply, discipline is tested. If your plan requires constant discipline, it's a fragile plan. A durable plan doesn't ask you to be strong every day. It removes the need to be strong every day. That's what we're about to build. Now let's build a calm setup that prevents the daily checking mistake. No platforms, no tickers, no complicated tools. Just a system you can apply with whatever you already use. The goal is simple. You should still be investing, but you should not be emotionally monitoring your investments like a daily scoreboard. So here are the 3 parts of the setup. First, separate doing from looking. Your investing actions should happen on a schedule. Your checking should happen on a schedule. And those schedules should not be daily, because daily checking invites daily reacting. So pick a contribution rhythm that's realistic. For many beginners, that's aligned to income, weekly, bi-weekly, monthly. The exact rhythm matters less than consistency. Then pick a review rhythm that is calmer, then your contribution rhythm. That's important. You might contribute monthly, but review quarterly, or contribute weekly, but review monthly. The review schedule is when you look at performance and rebalance your thinking. It's not an emotional check, it's a practical check. The second part, define what you will do when things feel scary. Not during the scary moment, right now, when you're calm. This is where beginners get real control. You write a simple rule for yourself. When markets drop sharply, I will not change my plan in the moment. That's it. You can refine it slightly. If I feel the urge to sell because I'm nervous, I wait until my next scheduled review before making any change. This does two things. It creates a speed bump, and it moves decisions away from peak emotion. Most bad investing decisions are fast decisions made under stress. You're replacing speed with structure. Now the third part, reduce your triggers. If you check daily because the information is always in front of you, remove some of that friction. This isn't about pretending numbers don't exist. It's about controlling what you expose yourself to. For example, if your phone shows you market headlines constantly, you don't need that. If your home screen has a widget showing daily moves, you don't need that. If you open your investing app out of boredom, you don't need that habit. Replace it with something calmer. If you want to feel involved, track what you can control. Track your contribution consistency. Track your savings rate. Track your emergency cash buffer so you're less likely to panic sell. Track your progress in building the habit. Because these are inputs, and inputs are where beginners win. Daily price checking focuses you on outputs you don't control. Now let me give you a simple routine that fits real life. Let's say you get paid every 2 weeks. On payday, your investing contribution happens. Then you close it. No extra checking. Then, once a month, you have a money day. This is a short session. You review your budget, you check your account balances, you confirm your contributions happened, and you look at your investments briefly. Not to judge yourself, not to predict, just to stay oriented. Then once a quarter, you do a slightly deeper review. You ask calm questions like, am I still contributing consistently? Has my situation changed? Is my time horizon still the same? Am I still comfortable with the level of ups and downs I'm seeing? Notice what's missing. There's no question like, is it up today? There's no question like, should I sell because of this week? Because weekly emotion is not a strategy. Quarterly review is slow enough to avoid noise, but frequent enough to keep you engaged. Now, what if you're thinking, but what if something really bad happens? 2 points. First, most of what feels urgent is not urgent, it's just loud. Second, if something truly changes your plan, a scheduled review is where you adjust calmly. The goal is not stubbornness. The goal is removing impulsive changes. Here's a helpful mindset shift. Instead of thinking, I'm checking to protect myself, think, I'm checking to reassure myself. Because that's what daily checking really is for most beginners. It's reassurance seeking, and reassurance seeking never ends. You check. You feel better for 5 minutes, then you feel uncertain again. So you check again. That loop can run for years. A better replacement is confidence through process. Your process is what protects you. Consistency protects you. A long time horizon protects you. Not reacting protects you. In a moment, I'll summarize this into one simple rule you can remember instantly. But before that, let's handle the most common objection. Some people say, if I don't check daily, I'll miss opportunities. For a beginner building a long-term plan, daily opportunities are usually distractions. Most opportunities that matter for long-term investing are not one-day events. They're years of steady ownership. So the real opportunity is not catching a dip today. The real opportunity is not sabotaging your own consistency. If you do want one small thing you can do that feels active without being reactive, do this. When you feel the urge to check prices, do a plan check instead. Ask yourself, did I contribute this month? Am I still on schedule? Is my next review date set? If yes, you're done. That's a calm win. And if you're still tempted, remind yourself. Daily checking is training your brain to care about the wrong time frame. You're training yourself to feel every tiny move. But long-term investing is built on a wider view. Now let's bring it home. So here's the full message of this video. The common beginner mistake is checking prices daily and reacting emotionally. Not because checking is bad, but because daily checking turns normal movement into constant stress and it quietly pushes people into inconsistent behavior. And inconsistency is what kills progress. The calm solution is simple. Separate doing from looking. Contribute on a schedule. Review on a calmer schedule. And create a rule that prevents emotional decisions in the moment. You don't need to rush. You don't need to be perfect. You just need a system that keeps you steady when things get noisy. If you want a simple way to remember it, use this. If you're investing for years, you don't need daily updates. Your plan should be stronger than your mood. In the next video, we'll take the next step and build an even simpler, beginner-friendly investing plan that doesn't feel complicated or overwhelming, so you can focus on consistency instead of constantly wondering if you're doing it right.